lecture for part 2 of chapter 23. So in this lecture, I'm going to pick up where we left off in part 1. So in part 1, we talked about material variances and labor variances. So now we'll talk about variances for the third type of cost, factory overhead. And I'm going to ask you to look at it a little bit differently than how the book talks about it. So the book makes they split into variable and fixed, and they kind of make an assumption that fixed budgeted overhead is always going to be equal to actual fixed overhead, which in the real world is never true. So I don't want you to learn something you'll have to unlearn later. So I take a little bit different approach to it. So the key thing about factory overhead variances, if you think about judging the cost control effectiveness of a production manager of a factory, we want to, of course, look how did they do with regard to direct materials, how did they do with regard to direct labor, but we also want to look at their spending on overhead. And in order to be able to judge them properly, we want to be able to split the variance between what we thought should be spent and what was really spent, between what they had control over and what was just a mere fact of the volume being different and the fixed portion being spread over more units or fewer units, which really isn't the production manager's fault. It's just kind of the luck of what the volume was for that particular period. So we do that with the goalpost method. So in the goalpost method, it looks the same, but it's a little bit different than the previous two. So in this one, the goalpost on the far left is what we actually spent for factory overhead. That's straight from our accounting records. That's pretty straightforward. The far right goalpost is what we applied using our predetermined overhead rate. And it's really key to remember that we're going to apply the predetermined rate times the actual volume. Okay, so if, for example, we were applying overhead on direct labor hours, and direct labor hours were 4 hours for each unit produced, if it is normally 100 units as our capacity, but we only did 90, then it would be 90 units times the 4 standard labor hours per unit times our predetermined rate. So it's the number of the amount of standard activity that would have occurred under the existing actual volume, okay? And then the middle one is what is our flexible budget for overhead. So the fixed plus variable budget that we used when we came up with our predetermined rate, what is that? So what should spending have been? So when we compare the actual overhead spending to the flexible budget, that should tell us what the controllable variance was, or what the manager, how well they controlled spending. The difference between the flexible budget overhead and the applied overhead is going to be what is just the dumb luck due to the volume being different. And then in total, we have the total variance. So we did this back, I think, in chapter 2 or 3 when we talked about applying overhead. We had under or over applied overhead. That's the total variance. We're just taking that under or over applied variance for overhead, and we're breaking it into its 2 types of variance so we can say something intelligent or judge somebody's effectiveness based on that. So I think the easiest way to do this is to work through a problem together. So I'll post a separate video where I work through a problem like this, and I think that will help you with this. So here's one way to take a look at this. So we have here what the actual was at the budget at actual production. So a flexible budget is that column in B there, and then the actual spending, and we can look at where there were deviations specifically to kind of drill down to where there might be particular problems. So next thing I want to talk about is how we do journalizing of this information. So we're always going to have unfavorable variances are going to be debits, favorable variances are going to be credits. We're always going to debit work in process for standard cost, and then we'll credit, whether it's materials or payroll or factory overhead, for the actual. So we can handle direct materials one of 2 ways. So in this case here, we're looking at the price variance when we purchase the material, and then looking at the quantity variance when we consume it. So you can do it that way, or you could do it combined when it's consumed, which just has the effect of delaying the recognition of the price variance until later. Again, I'm going to go over some journal entries in the practice video that I post next, so wait for that, and I think that'll make it a bit more clear. So here's an income statement that shows variances from standard costs, so we can see what the cost of goods sold was at standard, what all of the variances were. In this case, it was 3,550 variances to come to gross profit, so additional costs, so unfavorable exceeded favorable, but we can see the detail. This is an internal only kind of income statement. We wouldn't share this with outsiders necessarily, but this just gives us a better view into what happened in a company. So the last thing I want to talk about is what do we do with these variance accounts at the end of the accounting period, because we're not going to have them on our year-end financial statement. It's something for internal purposes only. So, they're temporary accounts. They need to go somewhere. So how we'll dispose of those, if the total net variance is minor, we'll just debit or credit it to cost of goods sold. So if it's a relatively small amount, and what is relatively small, I would look back at what the company has done in the past. If it's a material amount, then we'll prorate it between cost of goods sold, work in process, and finished goods. If it's due to some kind of unusual circumstance, like a flood or a fire or an earthquake or something like that, then we would charge it to other loss so it doesn't kind of pollute or distort the cost of goods sold and the gross profit figure. So that's the lecture for the second part of this chapter. It's relatively short because I want to spend a little bit more time working through some problems with you. So please look for that video on Canvas shortly. Thank you very much.